In the news, a recent Moody's analyst note comments on the recent NYCB announcement that caused new concerns around commercial real estate downside and how that downside may be exaggerated and has limits. From the note, New York Community Bank Corp announced a significant and unforeseen fourth quarter loss and cut their dividends, reigniting rampant concern about regional bank instability that began nearly a year ago with the failure of Silicon Valley Bank. Those concerns were largely driven by speculation of a doom loop between potential commercial real estate loan losses and the constrained liquidity of banks causing further loan losses. The share of troubled CRE loans will increase in 2024 as banks face roughly another $441 billion in CRE loan maturities, and many banks continue to tighten their underwriting belts in the face of uncertainty. However, to understand the full risk picture, it's important to note that there are many mitigating factors that blunt potential losses, both for NYCB and regional banks generally. The notation then goes on to comment on NYCB specifically before getting to some of the broader issues around commercial real estate exposures. The current vulnerability of CRE property performance is highly concentrated among office properties, particularly for those with near-term loan maturities and high lease rollover. Now, there are some rising concerns for segments of the multifamily sector, particularly for those with aggressive underwriting of future expected rent growth in markets with lower affordability. But the issue really has been constrained largely around office properties. NYCB, like the majority of regional banks, have limited exposure to non-residential CRE assets, i.e. office. Delinquencies and losses have been very limited for commercial real estate so far, and value declines have been more muted than many widely understood. But these statistics are likely to get worse in 2024 before they get better, Moody's noted. With roughly $441 billion of loan maturities coming, some loans will have issues refinancing into a higher interest rate environment, and in some cases, slowing CRE space demand. As one indication, they expect roughly 75 to 80% of the maturing CMBS office loans in 2024 to have issues with timely payoff. Banks with higher exposure to these maturities will see a combination of more charge-offs and delinquencies, and in many cases, workouts and extensions will curb or delay losses. As noted, there are a number of mitigating factors overall that limit the downside risk for banks, despite real challenges with loan maturities. Some examples of these mitigants include significant rent growth since loan origination, above average risk premium baked into property cap rates post 2008, below average new construction rates, and lower leverage loans compared to prior cycles. Additionally, commercial real estate is a diverse market of many asset types and varied performance. And even among the most stressed office sector, there are many examples of assets and markets that are performing well. Therefore, it isn't appropriate to look at the potential risk for banks by painting with a broad brush and simply looking at overall commercial real estate exposure. Finally, the note mentions the economy at large is looking stronger, with upside surprises in measures such as GDP, jobs, manufacturing, all of which are supportive of commercial real estate. Further, the rate of inflation has subsided to within striking distance of the Fed target, resulting in the Fed signaling a potential for loosening of monetary policy. So despite what is common in media and journalist reports that really describe commercial real estate as a cataclysm or a nightmare or a horror story or stuff that, quite frankly, is often clickbait, Moody's does a fairly good job of making the points that the issues to the banking sector are oftentimes quite a bit less than what has been described in the media. A lot of banks don't have overexposure to the office sector, and the office sector in a few urban downtown markets, which is really where most of the problems are. And a lot of commercial real estate is doing quite well, and a lot of banks are diversified away from the areas that have these issues. Plus, with the economy having improved and the Fed no longer in the hiking cycle that it was before, a lot of the pressure has been off. So notwithstanding that there are definitely some issues on some of these balance sheets, there are some issues with some loans. This notation does a fairly good job of giving a little bit more of a less entertaining, less clickbait-ish, but more accurate summation of the issue, in our opinion.